Today I'm going to be talking about Axis Triple Advantage Fund and specifically the benefits of true diversification in the fund. Now, Axis Triple Advantage Fund invests in three asset classes: equities, fixed income and gold. Now, we know that as Indian investors we invest in all of these three asset classes. We invest in fixed income through our fixed deposits, we invest them in our PF and maybe even in bond funds. We invest in equities through direct stocks and mutual funds, and of course we buy a lot of gold. In fact, this combination of three assets has worked very well to diversify the risks in our portfolios. We looked at the last 18 years of data going back to 1994 to see how a combination of these three asset classes would have protected your portfolio over a period of time. What we found very interesting over this 18-year period is that if you invested roughly equal amounts of money in equities, bonds and gold, it is very difficult to lose money. In fact, over this 18-year time frame, an equal weighted combination of equities, bonds and gold has lost money just one time out of 18. And how does this happen? This happens because the three assets do not always work in sync. We know that equities do well when the economy is doing well, equity markets go up when the economic cycle is in upswing, and bonds do well when the economy is turning soft, when inflation is low and when growth is low. Gold, which is the third asset class, works as a risk hedge. It works best when there is a crisis or when there is a lot of risk in the economy. The combination of the three has ensured in the past that the average return of the three asset classes has remained positive for 17 out of 18 years from 1995 to 2012. In fact, if you dig a little deeper, you will realize that in 17 out of 18 years, at least 2 out of the 3 asset classes have individually delivered positive returns. That is to say that only 1 year did 2 out of the 3 asset classes in fact turn negative. That is just 1 year in 18 years. And that is really the story of diversification. What to me was very surprising or is surprising is that the year in which the average return turned negative was not 2008. Now, remember that 2008 we were faced with a global financial crisis and equities fell by over 50%. Even in a year like 2008, if you had invested equal proportions in equities, bonds and gold, you would have arrived at a positive average return at the end of that year, because during that year gold and bonds did very well in response to a slowing economy and a crisis like situation. Now, we looked at average returns on an annual basis. If you look at average returns on a 3-year rolling basis, that is if you had invested in any period and looked at the next 3-year returns, the results are no different. If you look at individually stocks, bonds and gold, you will find that average returns on a 3-year cycle from stocks are the best and bonds and gold lag behind a little bit. But what is really interesting is how much variability there is in the returns. When you look at stocks, despite the average returns of about 12.5%, the range of returns has been as much as -15 to over +50% compounded for 3 years. On the other end of the spectrum, you have fixed income, where the average return may be slightly lower, but what is really interesting is there are no negatives. Gold is in between, which has average return close to the other two. It has delivered some negatives up to about -8 or 9% on a 3-year cycle, but as much as +30% when the going gets good for gold. What is very interesting for us is that if you mix the three up together, you arrive at a triple asset, which is a conceptual idea, which has average returns slightly better than stocks. That is to say that it is able to deliver returns similar to stock markets, but its risk profile, that is defined by its variability, is very, very low. And indeed, in this 18-year simulation, we find that its risk profile is closest to that of bonds, having never delivered negative returns on a 3-year cycle. So, this is how diversification works for you. On the one hand, it enables you to reduce the variability of your portfolio, and on the other hand, you actually do not lose much by way of returns as well. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.